Well, hello, everybody. Welcome to Tax Talk, when we get together and talk all things tax as they relate to real estate. And today, syndication. My name is Robert Helms, host of the Real Estate Guys radio program. With me, it is co-host, financial strategist Russell Gray. Hey, Russ.
Hey, Robert. Hey, everybody.
Every time we get a chance to talk tax, I know you love that. And tax is part of the reality of all real estate investors, whether you are just starting out and you're looking at how does investing in real estate kind of overlap into your regular day job or your business, the way you earn money, all the way up to, of course, real estate investors don't pay a lot of tax, as we're going to learn today. We're super excited to have Tom Wheelwright with us. In fact, Tom has been on Tax Talk before, but recently we were able to pick Tom's brain regarding real estate syndication. So for folks that are raising money, as well as for the updates that are happening this year. So Tom Wheelwright is a certified public accountant and real estate investor. You probably know him as the best-selling author of Tax-Free Wealth and the Rich Dad Advisor for Tax. Tom also hosts the Wealth Ability Show. That's his podcast. And Tom is an awesome guy, as you're going to hear now. Let's say hello to Tom Wheelwright. Hey, Tom.
Hey, thank you, Robert. Thank you, Russ. It is so good to be with everybody here in the syndication show, right? This is Syndicators. I wished I could have been there live. Next best thing, but this is good recording, so this should be great. So for those of you who don't know me, maybe a little bit about my background. I grew up in Salt Lake City, Utah. Good Mormon boy. Spent 2 years learning how to take rejection in Paris, France. And then spent another couple of years at the University of Utah to get my undergraduate in accounting, and a couple of years at the University of Texas to get my master's of professional accounting with an emphasis in tax. I spent 7 years with Ernst & Young, one of the largest CPA firms in the world, including 3 years in their national tax office, 4 years as the in-house tax advisor for a Fortune 1000 company, 14 years as an adjunct professor in the Masters of Tax program at Arizona State University, and about 25 years building CPA firms. For the last several years, I've been traveling a lot with Mr. Kiyosaki, Robert Kiyosaki of Rich Dad Poor Dad fame. We travel around the world, and because we travel so much around the world, the most common question I get is, how do I find somebody like you here? And so the last couple of years, I've been spending most of my time developing a network of CPAs. We are now, you guys didn't know this, but we are now international. We have a CPA firm in Canada. We have CPAs all across the US, and next year we'll launch across the oceans. So very excited to be here with y'all. Like Robert said, I am a real estate investor. I do believe that it is different when you're doing it yourself. You have a little better understanding, but I also appreciate what you said, Russell, about cachet, because that is actually, when you're trying to establish credibility, your team is going to establish the credibility for you. So I appreciate that, Russell. That's a really good point that I think people don't pay attention to, and who your CPA is actually going to play a part in that. As to who's on your team, we do in my little CPA firm, I handle about 50 clients in our little CPA firm, and we handle a couple of very large real estate syndicators, and we know that our name is in those syndications as part of their team. So I appreciate that, Russell. So let me start a little bit with just kind of a little bit how the tax law actually works. Some of you have seen me speak before, so you will have seen this, but it's always good to review. That's how we learn. And I'm going to start by using Robert Kiyosaki's Cash Flow Quadrant, book number 2, after Rich Dad Poor Dad, to make this illustration. And it's really going to illustrate the point that you guys made earlier about who pays tax and how much tax they pay. Because the reality is, once you become proficient at real estate syndication, if you're paying tax, that's a problem, okay? And that's legally. So very clearly, just be really clear, everything we're going to talk about is legal, ethical, and moral, no cheating allowed. So there are really 4 ways that we really can make any kind of significant income. One is as an employee. One is as a small business, self-employed specialist, doctor, lawyer, accountant. One is as a big business owner, and one is as what we would call an inside investor. And this is exactly appropriate for you guys, because as syndicators, you are by definition an insider. Okay, you're going to see deals that other people never see. You're going to have opportunities that other people never have. What's really been fascinating to me as I've traveled around the world with my friend Robert Kiyosaki, is that how you make your money has a major impact on how much tax you pay, because the rules are not the same for everybody. If you've ever heard the idea, oh, the tax law is not fair. Well, I think it's fair. It's just fair if you're doing the right things. Okay, everybody gets to do the same things. Everybody has the same opportunities to do the same things. It's just that most people don't know what you can do. So here's what happens. Typical employee, which is a good 80% of the population, is just employees. Okay, that's where all their income comes from, outside of maybe a little stock market or cryptocurrency investing, right? They're going to pay about 40% if they're making a good income. And that's, by the way, true all over the world. That's not just in the US. That is a common tax rate around the world. If they're self-employed, typically they're going to be around 60% because they're paying the employee's share of the tax, but they're also paying the employer's share of the tax. So now you double up on taxes. A big business owner is probably going to be down around 20%. So when you hear a Warren Buffett say, I pay less tax than my secretary, what he's really saying, I pay a lower tax rate than my secretary, because the secretary is paying tax at 40% and he's paying tax at 20%. Just the difference in how they make their money. An inside investor with the right team should pay zero. So let me give you an example of this. So we just got through an election here in the US. And you'll recall that we had one candidate, Joe Biden, who is now our president, and he's always been an employee. So he's paid right around 40%, 30 to 40%. That's what he said. His vice president candidate, Kamala Harris, you saw their enormous tax bill. I'm going, these guys need a new tax advisor. They had this enormous tax bill. Well, her husband's an attorney. That's where he makes his money. He's a specialist. So he's going to pay upwards of 60%. Then we have over here the other candidate, Trump. And what did they say? What did the New York Times said? The New York Times said that 10 out of 15 years he paid zero. Well, so the New York Times is just aghast at this. And every tax advisor who knows real estate is like, well, duh. Of course he pays zero. This is, like he said in the 2016 campaign, that's because I'm smart. Okay, he's smart, he invests in real estate. Let me give you an example of this. So you might remember that from the New York Times article that he paid about 400 million. He earned about 400 million on The Apprentice, right? He earned about 400 million on The Apprentice. Then what he did was he put that money over here into his real estate developments, and he got back a $70 million refund. Okay, that is how it works, folks. That is exactly how it works. But let me explain some of the primary differences between this side and this side that affect you from both how much money you're going to make and from a tax standpoint. So one of the things that happens over here, and Russell alluded to this, this is, I think, the three most expensive words in the English language: do it yourself. That's what these guys do. You know, if you want it done right, you have to do it yourself. This is what we grew up learning, right? Over here, these people, no. It's all about a team. You can't have, by definition, big business, 500 employees, that's a team, okay? Syndicators, you got to have a team. This is all about the team. So these guys play a whole different sport, right? As Kiyosaki says, business is an investing, they're team sports. Okay, so you really can't be successful business investing if you're going to do it yourself. Now, okay, so how do we get to the 0%? That's hopefully what you're thinking about. And one of the things to remember is that the tax law is fundamentally, this is what we talk about in tax-free wealth, the tax law is fundamentally a series of incentives. Okay, so we have one line that says all income's taxable unless they say it isn't. We have one line that says nothing's deductible unless they say it is. And then we have about 6,000 pages of instruction guide on how to reduce your taxes. Basically, incentives. But last year, in the last 15 months, we've had 5, count them, 5 major tax bills in the last 15 months. 5 of them, starting in January, and then this ending with this last one. Every one had tax implications. Guess what? They were all incentives to do certain things. Think about this last one. Okay, this last $1.9 trillion helicopter money, right? So what was it? It was incentives for, you saw incentives in there for children, right? The more children you have, the more money you got. You saw actually incentives for businesses in there. Restaurants got huge benefits in that bill. You saw actually there were incentives for unions. There were incentives for government workers. I don't know if you saw this one, Robert and Russ. You know that in that last bill there was a provision where if you're a federal worker, you get 16 weeks off for COVID, paid leave, 16 weeks. Wow. Federal employee. So and there were incentives for people who went to college and had a student loan. Okay, I mean, the bill was about it's just, they call it a stimulus bill, right? Stimulus bills, incentives. Every single tax bill is some kind of a stimulus bill. Remember, taxes are either an incentive or a punishment for doing what the government wants you to do. Well, if that's the case, then the question has to be, what does the government want me to do? Right? So why do these people over here get a 20% rate? Because they create jobs. Why do these people get a 0% rate? They create housing and energy. That's what they're doing. And in exchange, the government says, look, you have a choice. You can be a silent partner. Now, we're all partners with the government, like it or not. You don't get to choose. If you're a full-time resident in the US or a US citizen, you are a partner with the US government. Now, you can be a silent partner and pay 40 or 60% in tax. Or you can be an active partner, find out what they want you to do it, and pay 20% or 0% in tax. What we're talking about in real estate, now, I was in Washington, D.C. in 1986. I've actually, just so you know, this is my 40th year doing taxes. So I am absolutely as old as I look. And what happened in 1986 was we had major tax reform. What was the result of that major tax reform? We had the worst real estate crash in history in 1989, 1990, 1991. We literally had acres of great real estate going for 50 cents a foot. Okay. I mean, this is the Resolution Trust Corporation. The banks owned a bunch of real estate. The government ended up owning a bunch of real estate. Huge crash. Why? Because they took all the tax benefits away from investors in 1986 from real estate investors. Well, around 1993, they added a bunch back. That, by the way, was a result of this guy right here. He was one, it was his lobbying, among others, that got what we got called the real estate professional status in 1993. That was a big add back. Then, of course, he becomes president. So what happens? We get huge tax benefits for real estate in 2017. So what I like to start with is just talk about a couple of the real estate tax benefits, and then let's talk about how to use them, because I believe my experience when I run the numbers is that in your first year, your real estate tax, the tax benefits from real estate are going to be by far the biggest return for your investors. By far. There is no way you're going to get a better return on anything else in your real estate than tax in that first year if you learn the rules and do it the way you're supposed to do it. So let me kind of walk through some of that stuff. So the first thing to understand in real estate when it comes to taxation is the big benefit is what we call depreciation. And you mentioned my friend Dave Zook. So Dave and I met on the cruise, right? That's when he learned it was when we had these conversations on that cruise years and years ago that he learned, wait a minute. That's when he came to work with us. And we said, look, depreciation is like magic. The very first time I was ever on stage, by the way, with Robert Kiyosaki, he said, explain depreciation. I said, well, it's magic. He says, why is that? I said, well, because you get a deduction without losing any money. It's really one of almost the only places you can get a deduction without losing any money. All right. Most of the time you have to actually spend it. It's gone. But real estate, you buy real estate. Okay. You haven't lost anything. You've got the real estate. It's worth the same amount you paid for it the day after. Okay. Unlike some things, the day after, right? You buy a car the day after, it's worth, 30% less. But real estate's worth at least as much the day after as it was the day you bought it. And you can improve it. And it keeps going up in value. Okay. And it makes money. But on top of that, we get all these tax benefits called depreciation. Well, what is depreciation? Well, depreciation is really, if you've got this, let's say you've got this building here and you've got some landscaping here, okay, and you've got maybe some, some outdoor lighting, and we'll pretend this is lighting, right? And you've got some fencing and stuff like that, right? You got some fences over here, right? This is all something you paid for all that. Well, okay, you paid for it. It's going to have some wear and tear on it. How do we account for that? Well, what we do is we get what we call depreciation. So we know the land here, it's not going to have, the depreciation is going to be zero, right? Land doesn't wear out. So it's going to be zero here. Well, what about over here? What about the land improvements? Well, they're going to wear out over about 15 years. Okay, the building is going to wear out over somewhere between 27 to 39 years, okay, according to the government. And what's inside the building, flooring, window coverings, all that kind of stuff, is probably going to wear out in around 5 years. So that wear and tear over those periods, we get to deduct. So if we paid $100,000 for the outside, for the land improvements, we can deduct that over 15 years. If we pay, $50,000 for what's inside, we're going to deduct that over 5 years, and the building we're going to deduct whatever over 27. In residential, it's 27. In commercial, and by the way, when I say residential, that means somebody lives there. It has nothing to do with the size. Or commercial, it's 39. So commercial like office and industrial. All right. So what happened in 2017 is we got changes here. And instead of 5 years, this is now 1 year. And instead of 15 years, this is now 1 year. So that means everything you spent with regards to what's inside the building and what's outside the building that's an improvement other than the building itself is going to all be depreciated in 1 year. We call that bonus depreciation. And typically that's somewhere between 20 to 30% of the purchase price of that building. And guess what? It doesn't even matter if it's new or used. So in the US, we get to depreciate used property over and over and over again. It's an amazing thing. Very few countries do that. We do it. Okay. Well, what does that mean? That means that, let's say that you paid $1 million for your fourplex. All right. Just take a fourplex. You can add a 0 if you want, 2 zeros if you want. Okay. You're doing a big deal. You paid $1 million. You probably put down, let's say you put down $250,000, right? That's your down payment. And the bank put in $750,000. Okay. But the cost was $1 million. The good news is the bank gets no tax benefits. None. They've taken 75% of the risk here and they get none of the tax benefits. It's beautiful. Okay. You as the investor, you took 25% of the risk, but you get all the tax benefits. Well, let's say it's 30%. Let's say that you calculate, because you do what's called a cost segregation, and you calculate the depreciation, the bonus depreciation is 30%. Well, 30% of this, not 30% of this. So 30% of $1 million, not 30% of 250,000, which means it's $300,000, which, by the way, is more than you put into it in the first place. So you could literally have a deduction the first year for more than what you put into it. Only real estate. I found you can do that. Okay. Now I think down the road, we'll talk about in a few minutes, we'll talk about President Biden's plans. I think we're going to see the same thing happen in some other areas going forward. But this is where it happens now. It happens in real estate. Well, how do I make sure I get those benefits? Well, some of you have probably heard that, wait a minute, my investors say they don't get it. They don't get this because they're passive. Okay. Well, your investors don't get it because they don't have the right team. Okay. Because passive doesn't mean it's not deductible. Passive just means it's deductible, but you have to do things to make it deductible. So one of the things we always say, people ask is, they'll say, okay, if I buy this book, is it deductible? Well, I'd like to change the question here. And the question should be, if I buy this book, how do I make it deductible? And the same thing is true with the real estate. Okay, if I'm a passive investor, how do I make that passive loss, because that's going to be a loss the first year, how do I make that deductible against my other income? That's the question that, by the way, your investors and you should always be asking your tax advisor. Don't ask, is this deductible? Ask, how do I make this deductible? My experience with entrepreneurs is I've never met an entrepreneur that wanted to be told no. Right? No entrepreneur wants to be told no, because the whole idea of being an entrepreneur is to figure out how to make it yes. Right? That's the whole idea, is to solve a problem. That's what entrepreneurs do. Well, so what we want is we want team members who behave like entrepreneurs as well, so that they're looking at how can you do this. So if you find you're running up against a wall with your CPA, tax advisor, lawyer, etc., might want to consider that there are other advisors that, rather than saying no, will say, would you like to know how you can do this? That's just a different mentality. So who's on your team makes such a big difference. As Russell said earlier, that is the key. And part of it is, what questions do they ask and how do they respond to your questions? So this is basically the big deal in real estate. So think about that. If you got $300,000 and you were in a 40% tax bracket, what does that mean? That means that of the $250,000 down payment, really the government put in $120,000 and you put $130,000. That's literally what that means. So they risked, the government said, you know what, we'll take a piece of that action. with the goal, of course, that the government is saying, well, down the road, you're going to make money and we're going to get paid. It's a legitimate business deal, right? We do it all the time with partners. You have investors and you do a syndication and you go, look, here's the deal. You're going to get paid first and we'll take our money down the road as developers. That's all the government's doing. They're just saying, you get paid now. We'll give you a tax benefit now. We'll take our money down the road. And that's exactly what's going on. Now, of course, if you keep doing this over and over again, you never end up paying tax, right? You just continue to push that down the road and you're never going to end up paying tax. We have real estate investors for clients who have not paid tax in many, many years legally because they followed this formula. Okay, so that's simply how real estate works. Now, this passive idea, let me address one little thing here. And that is, some of you have heard this term. Which is real estate professional. This is not somebody with a license to sell real estate. That's not what defines it. This is a defined term in the tax law. And it's a very simple defined term. Really easy. It means you spend more than 750 hours per year actively involved in real estate. And you spend more than all other. That's it. I've never met a syndicator that didn't qualify, ever. Syndicators, by definition, as a syndicator, you qualify. Now, as an investor in a syndication, are you going to qualify? Most of them will not, but a syndicator will. So this is a really good, going back to my friend Dave Zuck, this is an indication of why he really wanted this. I remember he really wanted this and goes, I want to be that real estate professional. Now, what also happens? Real estate professionals make more. I mean, you make more money than the investor, right? So you're getting return on your money, but you're also getting return on their money. They're only getting return on their money. So being in syndication is, if you're going to do real estate and you're going to do it in a big way, syndication is the only way to do it in my mind. Now, but you have to make sure you also invest in real estate. I had a situation with a client, and I can tell you who he is because he talks about this all the time. By the name of Brad Sumrock, right? Frequent guest at the Real Estate Guys. And Brad was a syndicator, but he never did his own deals. So he got all these tax benefits for his investors and didn't get any for himself. So the very first thing I told him is, I said, Brad, stop doing that. You're an insider. You have all the inside deals. Do your own deal. First year he did his own deal, literally, and he'll tell you this, saved him over $900,000 in tax the first year. He has not paid tax since. And that's because he keeps doing the deals, right? It's a bit of it becomes a bit of an addiction, real estate investing, because you have to keep doing it to not pay tax. If you stop doing it, you have to pay tax, right? It's like exercise, right? And they say it takes only 72 hours for your muscles to start diminishing. So you got to keep doing it. It's got to become an addiction. Same thing is true with investing. It's got to become an addiction, what I call a positive addiction. But it also means that your taxes, literally his went from 900,000 to zero in 1 year. Now that's not going to happen with most of you because most of us most people don't make 900,000 in the first place. So they're not paying that kind of tax. But for Brad, he was making a lot of money in his business, and 900,000, he goes, yeah, I make a lot of money, so I pay a lot of tax. I'm going, Brad, why would you do that? You don't have to do that. You're an inside investor. And that's what's key about real estate. You guys, and here's the thing, this bonus depreciation, At best, we have 2 more years of full bonus depreciation. Then it starts dwindling down. Depending on what the Democrats do in the Senate, that may be gone quickly. Okay, if they decide against the filibuster, then that could be gone tomorrow, literally. So we need to do this now. Now, what we do know is most tax laws are not made retroactive. So right now is the time to be doing this. Right now is the time to be learning about this, getting into this, and really learning how to be a syndicator. Now, here's what we do know. We're not going to lose this. We're not going to lose this right here. Okay, we're not going to lose the 5-year, 15-year, 27, 39-year. That's not going away. Before 2018, this is what we did. We still did cost segregations. It's just that you had to do a little more real estate, took a little more time. So there's always going to be real estate tax benefits. There's so much public policy behind it. It's always going to happen. So let's shift gears, and I'm glad this is recorded because I know it's just been like a fire hydrant so far. So I'm going to keep going with the fire hydrant. Let's talk about what's going on in Washington, D.C. right now, because it's I have not seen anything like this of what's going on in Washington, D.C. In my lifetime. Because here's what we have. We have one party, and I don't care if you're a Republican or Democrat, we have one party that is so intent on their agenda that they're threatening basically what we call the filibuster, which means that they would like to have a simple majority in the Senate be able to pass any bill. Will that happen? We don't know. But here's what we do know. They had one shot at it already this year, and they took it with the $1.9 trillion stimulus bill. We also know that they have another shot of it, shot in October. Okay, fiscal year for the government ends September 30th. Therefore, they have another shot of a simple majority, regardless of what they do with the filibuster. They have another shot under what's called budget reconciliation in October, November, December. That's why when you saw the 2017 Tax Act passed, it passed September, October, November is when they dealt with that, and it passed in December because the Republicans used that same rule and they passed it with just Republicans. No Democrats voted for the 2017 tax law. We can pretty much expect no Republicans will vote for this, but if they get 100% of the Democrats, then they can pass it because they do have a simple majority. Well, what are they talking about? So they're talking about a number of things. First thing they're talking about is really simple. Higher rates. They're talking about higher rates. They're talking about pushing the rates up. There's even some talk about going back to the old 70% rate on super high income. We had that. So I remember that actually when I first started my career at Ernst & Young, we had a 70% tax rate. Ronald Reagan changed all that. He got us actually down to, he went from 70%. So get this, in 6 years, he went from 70% top rate to a 28% top rate. Now it's back up to 37. Democrats say they want to make it basically 40. However, remember, we also have state taxes. Hawaii is looking at raising their rate from 11 to 16%. California is looking at raising their rate from 13% to 17%. Arizona, my home state, just voted an 80% tax increase if you make over $250,000 a year. Okay, it's not a lot of money. Over $250,000 a year. The people who don't make $250,000 a year voted the people who do make $250,000 a year to pay 80% more. That's what happened. It's easy to vote for somebody else's taxes to go up, right? So higher rates are happening. They're already happening, but we're especially seeing it because the Democrats said yes. Okay, now what about capital gains? This is a very interesting one, and we have some new information just this week on their capital gains proposal. So there are two types of well, there's three types, but there's two types of good capital gains. There's capital gains from selling stock, and there's capital gains from selling a business or real estate. Okay, they're actually talking about both. Okay, so I want to be clear. This will, I think, if they raise capital gains rate, it will affect real estate. And what they're saying is they want real estate capital, any capital gains over $1 million to be taxed at the 40% tax rate. So they're going to more than double the tax when you sell a property. Well, that's significant. But again, if we have bonus depreciation, we can offset that. Right? So this is going to make tax planning that much more important. Another huge one that they're looking at is estate tax. And the current proposal is that when you die, so just so you know, this is how Canada does it now. So they want to adopt the Canadian tax code on this. And what they say is, if you have over $1 million of appreciation in your estate, then you're going to pay capital gains on that appreciation. Well, so Canada has a capital gains rate of 15%. They want our capital gains rate to be 40%. So here's how this would work. Any business, any family-owned business where the owner dies is going to have to sell their business in order to pay this capital gains tax. There's no way they're going to be able to afford it. Every farm, every family-owned farm will have to sell their farm to the big guys. So this is a way to get more money to the big companies, in my mind. That's what's happening. I'm a little passionate about this. I think this is absolutely the worst idea I've seen since 1980 in the Windfall Profits Tax Act. Okay, this estate tax would devastate small business, real estate, and agriculture. Absolutely devastate those three parts of the economy, because the taxes, they're not taxes on something where people actually got money. They're taxes on, they're like a wealth tax, but not a 2% wealth tax like Senator Warren proposed, a 40% wealth tax. Okay, that's what we're talking about with only $1 million exemption. So $1 million, as you know, you're looking at a real estate deal, $1 million of gain is not that much. $1 million of gain from selling a business is nothing. Okay, you work all your life to build this business. You take all the risk, and then when you die, your family has to sell the business to pay the tax. So that's what's going on. These are the three big proposals right now going on in Washington, D.C. And we will, by the way, we'll see this one. Absolutely no question. We will see this one this year. Okay, this one we could see. This one has, there's some reasons not to have it. This one, I hope we don't see, because it would be devastating. It would just be a travesty, such bad public policy. But that's what we're looking at right now. We're looking at higher rates. Just remember though, the tax law is and always will be a series of incentives. All we have to look for is where are the incentives. So here's my prediction, and you can hold me to this, Robert and Russell. My prediction is we're going to see massive tax breaks in solar, wind, and other renewable energy. And guess what? They're going to apply to real estate, because what's going to happen is you're going to have charging stations at your mini marts. You're going to have, and that's a real estate play, right? You're going to have solar panels in the desert. That's a real estate play. You're going to have wind farms going up. That's real estate. So just look for, what happened in 2017 was really an encouragement to, more than anything, residential real estate. What we're seeing in what we're going to see this year, I think, is an encouragement towards energy related real estate, specific clean energy related real estate. And when we do, all we have to do, that's why it's so important that you have a team, right? Because it's your team that's going to let you know, by the way, so here's your strategy. Let's be looking this direction. Remember, taxes are 40%. They're 40% of your income. Most people will never have an expense that even comes near as high as taxes. Now, I want to put one more plug on the syndications when it comes to taxes, if I could. I think the biggest mistake I see in syndications is not espousing the tax benefits of the syndication. I rarely see a syndication that actually lists out the tax benefits. Now, my syndicators do, but I rarely see that. They do because I write it for them. Okay, I'm writing that piece of their offering memorandum, and their attorney's blessing it and putting it in, right? Because taxes are such a big part for that first year profitability. I mean, think about this. What if you could invest, you get the benefit of investing 100,000, but you only have to put in 60,000. That's what we're talking about. And let me add one more thing. So one of the biggest mistakes that syndicators make is their CPA, who sometimes, just sometimes, maybe like most of the time, says, well, your investors aren't going to get those losses because they're passive. Well, if those investors are my clients or my network's clients, Wealth Ability Network, they're going to get those losses because we can figure that out. It's completely legal. You just have to change the way you think about it. The question is not, can I take these losses? The question is, how do I take these losses? So if you've got a CPA saying, don't do a cost segregation, you've got a CPA saying your investors aren't going to get the benefit, then you definitely need to upgrade your CPA. And whether it's me or somebody else, I don't care. What I care about is that real estate investors, this is the big incentive in the tax law, and to lose that incentive because you don't have a good tax system, you don't have good tax advice, you don't have a good tax team, I think it's just a sin. And you're just harming your investor and harming yourself. And why not have this great marketing tool called taxes? Every financial planner in the world knows that you lead with taxes. Life insurance, they lead with taxes. Mutual funds, they lead with taxes. You got to do your 401k. They lead with taxes. Real estate, it's a natural lead with taxes. And I would just encourage you, don't be afraid of it. Just need to have the right team members on board so that you can make sure that you're doing it the right way. Because as Robert said earlier, you guys, and Russell said earlier, you're not tax advisors. So you don't want to, by the way, giving tax advice is practicing law. Accountants can do that because it's the authorized practice of law, okay, for a licensed CPA. But you don't want to be practicing law without a license. So that could be bad. So make sure that you've got your team in place. But I'll tell you, when you do that, there's no question that getting to zero tax is absolutely doable. So if there's anything we can do, I'm sure Robert and Russ, you'll put up our website, wealthability.com. You'll show everybody where to go. We're happy to help if we can. If we can't, we'll let you know. But like I said, we have a network of about 40 CPA firms around the country and in Canada. So if there's something we can do to help, we're happy to do that.
All right,
Questions?
good stuff. Big virtual hand for Tom Wheelwright. That was great stuff, my friend. And
That's
I
like
think
this,
a lot
right?
of folks. What's that? Oh, virtual hand. Yeah. Hey,
Virtual hand.
it can be intimidating. Taxation. And, you know, you're a guy that actually reads the tax code more than once when it changes, and yet still there's so much. So for a syndicator who maybe is focused more on the deal, focused more on the investor and suiting their needs, other than reading your fabulous book, Tax Free Wealth, what are some practical ideas on how folks can have a basic understanding of tax, but not cross that line as to giving tax advice?
Well, there is my show, the Wealthability Show, right? So there's lots of information there. Really, a lot of it is getting just a little bit of education, right? I mean, we actually have courses, as you know, just like you have courses on real estate, we have courses on tax, and they're very simple. But you really do need some basic education, because here's the thing. One of the things that you always have to remember is you want to change the tax, you need to change the facts. Okay. And that's all it takes. But here's the thing, your tax advisor cannot change your facts. All I can do is I can tell you which facts to change, but you have to make those fact changes, right? So if you want to be a real estate professional, you have to record those hours. You need to do the work. I can't do that for you. I can tell you how to do it. I can give you the education, walk you through step by step, and I'm happy to do that. You actually have to do, there's activities though you have to do. I'm down to setting up the right entity, setting up the right ownership, making sure that you're protected from lawsuits. Okay, this is all part of actions that you have to take. And if you take the right actions, you know which actions to take, you can actually very much lower your tax simply by changing your facts.
In fact, Dave Zook quoted you on that very thing on Friday morning at the syndication event and gave you full credit. So good stuff.
Before you go, 3 things. Number 1, subscribe. When you subscribe, you build up our subscription base, and that helps us reach more people. But even more important, it helps us attract great guests and subject matter experts to share their ideas and information with you. Number 2, click that notification bell to make sure that when we do post a new video on this hot topic, you're notified right away. And number 3, share. Please share this information with friends. Help them get on board this bus. Help them protect and preserve their wealth to take advantage of what's going on in the world today. All right, thanks so much, and we'll see you in the next video.